Hi, I'm Laurie Itkin. I'm a financial advisor with Coastwise Capital Group. I want to discuss annual returns. This is not investment advice. I am providing education here, and I think you'll find this video pretty interesting. So, when we talk about stock market returns, lots of people like to compare their portfolio returns with the stock market. How is the stock market doing? Oftentimes they are referring, whether they know it or not, to a benchmark, perhaps the S&P 500. That is a common benchmark used when trying to understand how the stock market is doing. Unfortunately, the S&P 500 only includes 500 of the most capitalized US stocks. It does not include stocks from other countries. It does not include what we call small cap stocks. It does not include bonds. And sure, investors with diversified portfolios often have bonds in their account. It doesn't include a lot of things. It is simply looking at 500 companies, and in fact, they are market weighted, which leads to certain companies. The performance of certain companies are actually responsible for a bulk of the return versus some of the other companies in that index. But be that as it may, we have people who like to compare their performance to the S&P 500. So let's look about that. Let's look and see, is that the right thing to do? So I have here Novel Investor with asset class returns over the last 15 years. And we go to 2020, and I'm going to look at the large cap. That's in this orange square. In 2020, the S&P 500 returned 18.4%. Depending on what you're measuring, that may be a little higher or lower, but in this case, they're saying that the S&P 500 returned 18.4%. It may include dividends, but it doesn't include fees. Okay, so in 2020, that looks pretty good. It returned 18%. In 2019, it returned 31%. Okay, so do you want your portfolio to look very close to the S&P 500? You may be looking at the last 2 years and going, yeah. Well, in 2018, the S&P 500 fell over 4%. And let's go back to 2008. Remember that crash? The S&P 500 fell 37%. So going into this year or the following year, do you really want your portfolio to mirror the performance of the S&P 500? Sure, in a good year you might want it to, but in 2008, if you mirrored the S&P 500 in 2008, you wouldn't be happy. Okay, so why do people compare themselves to the S&P 500? I just don't get it. Let's look at some other things. So here is, in this asset class returns, they've actually looked at the past 15 years. And large cap stocks here, the S&P 500, the average annual return over 15 years, and that's just an average annual. And believe me, you're not getting the average return every year, so don't count on getting 9.8% every year. In the best year was 32%, and the worst year, as I talked about, was 2008, with negative 37%. So I am trying to explain that if you are going to measure your performance by the S&P 500, or you tell a financial advisor, I want to invest in something that's like the S&P 500, get your seatbelt on, because be ready for highs and lows. Now, what the folks at Novel Investor has done is they've created this asset allocation portfolio, which is diversified. It's made up of 15% large cap stocks, so probably things in the S&P 500, maybe they're using the S&P 500, 15% international stocks, that's probably developed companies, that may include things like countries in Europe like Germany, England, it may include Japan, countries like that. Then it has 10% small cap stocks. Those are going to be smaller companies that are not in the S&P 500, smaller U.S. companies. Then it has 10% emerging market stocks. Those are going to be countries like the stocks in companies in China or Brazil. And then 10% REITs, real estate investment trusts. Those typically pay high dividends. And then they include 40% high grade bonds, which means investment grade bonds, probably not high yield bonds, but I don't know for sure. And they do annual rebalancing. What does that mean, annual rebalancing? It means that in a years where the S&P 500 has gone up a lot, they may at the end of the year, their allocation may be more than 15% large cap stocks, so they will sell in order to bring that down. And if emerging markets had done poorly, let's say, they would buy more emerging markets to bring that percentage up to 10%. So let's see how their asset allocation portfolio has returned over the years. In 2020, we talked about the S&P 500 going up 18.4%. Well, the diversified asset allocation portfolio went up 9.8%. But how did that asset allocation portfolio do in 2008? It only went down 22%, whereas the S&P went down 37%. Or you could look at bonds, high-grade bonds. You're less risky than stocks. In 2020, high-grade bonds went up 6%, and high-grade bonds in 2008 actually were positive. All these stocks were going down, but if you had bonds in your portfolio, those returned a positive. So the point is, we don't know what the S&P 500 is going to do for year to year. We do know that it's volatile, that it's going to have some good years, some bad years. So is it best to have a diversified portfolio? Many people would think that it is good to have a diversified portfolio because you're not putting all your eggs in one asset class. But if you have a diversified portfolio, you by nature are not going to necessarily see the big years. So let's see how the asset allocation portfolio did. Over the past 15 years, the asset allocation portfolio had a 7% annual average return versus 9.8% for the S&P 500. But the worst year was negative 22% versus the S&P 500, where the worst year was 37%. And let me tell you, these numbers may not seem like that much of a difference, but if you have gone down in one year, it's going to be a faster recovery than if you've gone down a lot that year. So I hope this has been helpful for you. Here's the website if you want to look at this yourself and understand how different asset classes have performed from year to year, and it may give you some insight as to what a diversified portfolio is and why it's important and why you shouldn't measure your performance using just one benchmark or one index. This is Laurie Yitkin. I'm a financial advisor at Coastwise Capital Group. Again, this is not personalized investment advice. It's education to help you become a more knowledgeable investor.